The foreign exchange, Forex, market is the largest and most liquid financial market in the world, facilitating the exchange of currencies for trade, investment, and speculation. Currency quotations express the value of one currency relative to another and are typically presented as currency pairs. In a quotation such as euro to US dollar, the euro is the base currency and the US dollar is the price currency. Forex participants include commercial banks, central banks, corporations, institutional investors, and hedge funds. Understanding how exchange rates are quoted and interpreted is fundamental for investment professionals because currency movements directly affect international portfolio returns, trade competitiveness, and cross-border capital flows. Forex dealers provide two-way quotes consisting of a bid price and an ask/offer price. The bid price represents the rate at which the dealer is willing to buy the base currency, while the ask price represents the rate at which the dealer is willing to sell it. The difference between these two prices is known as the bid-ask spread, which compensates dealers for liquidity provision, transaction costs, inventory risk, and market uncertainty. Spreads tend to widen when exchange rate volatility increases, market liquidity declines, or transaction sizes become unusually large. Consequently, bid-ask spreads serve as an important indicator of market conditions and trading costs. Currency quotations can be expressed directly or indirectly depending on the perspective of the observer. Market participants must also understand how to interpret spot rates, forward points, and all-in forward quotations. Spot transactions generally settle within 2 business days, while forward contracts specify an exchange rate for settlement at a future date. Dealers often quote forward rates using forward points that are added to or subtracted from the spot rate. Accurate interpretation of these quotations is essential because errors in identifying the correct bid or ask side can result in incorrect pricing, valuation, or trading decisions. Mastery of quote conventions is therefore critical in foreign exchange analysis. Triangular arbitrage is a strategy used to exploit inconsistencies among exchange rates involving 3 currencies. The process involves converting one currency into a second, the second into a third, and then the third back into the original currency. If quoted exchange rates are not internally consistent, traders can generate a riskless profit by completing the sequence of transactions. Because foreign exchange markets are highly competitive and technologically advanced, arbitrage opportunities are typically short-lived. The actions of arbitrageurs quickly eliminate pricing discrepancies by increasing demand for undervalued currencies and selling overvalued currencies, thereby restoring equilibrium among cross-exchange rates. The concept of triangular arbitrage reinforces the principle of market efficiency within the foreign exchange market. Cross rates derived from 2 currency pairs should be consistent with the quoted exchange rate for the third pair. When discrepancies arise, arbitrage activity generates profits while simultaneously pushing prices back toward their fair values. For CFA candidates, understanding Forex quotes, bid, ask spreads, and triangular arbitrage is essential because these concepts form the foundation for more advanced topics such as forward pricing, currency valuation, interest rate parity, and international investment management. Together, they provide a framework for analyzing currency markets and identifying potential trading opportunities.